Welcome to Balance of Economy. Before we dive into the data, please note that this is market research for educational and informational purposes only and does not constitute financial advice or a recommendation to buy or sell any asset. Let's look at the numbers. Welcome to today's deep dive. Imagine a scenario for a second where a business generates over $120 billion in, pure, unadulterated cash profit in a single year.
Right. A complete financial fortress.
Exactly, a fortress. Yet the moment the broader stock market gets a little nervous about geopolitical news, investors frantically dump shares of that exact company as if it's suddenly going bankrupt.
Yeah, it's this massive dislocation between the actual health of individual businesses and the emotional state of the people trading them.
Right, and that bizarre paradox is playing out on your screens right now. So the mission for this deep dive is to figure out what that emotional state means for you.
Because the numbers are definitely looking grim on the surface.
Oh, absolutely. Right now, in early April 2026, the S&P 500 is down somewhere between 7 and 9% year to date. The Dow and the Nasdaq have officially crossed into correction territory.
Which means they've dropped more than 10% from their recent highs.
Exactly. We've got oil prices spiking and just a general sense of dread taking over financial media. So we are pulling from a stack of fresh financial analysis, historical market data, and volatility metrics to answer one very specific question.
Is this a time for you to panic, or are we looking at a hidden historic opportunity?
Right.
And, well, to answer that, we first have to look at the underlying mechanics of how Wall Street actually measures panic. Because when you look at the raw data, the level of fear we are seeing isn't just a standard case of the market getting cold feet.
It's deeper than that.
Much deeper. We are seeing quantifiable systemic anxiety, and that fear isn't just an abstract feeling, it is tracked down to the decimal point.
Okay, let's unpack this, because I think a lot of people assume that market fear is just measured by looking at a chart and seeing how far prices are dropping.
Right, which isn't the whole story.
No, not at all. Wall Street has a very specific thermometer for this, called the VIX, the Volatility Index. To put this in perspective for you, think of the VIX as the stock market's insurance premium.
I like that analogy.
Yeah, because it doesn't actually measure price drops directly. What it measures is the expected speed and magnitude of price swings on the S&P 500 over the next 30 days.
Right, and because it is forward-looking, it tells us exactly how desperate major institutional investors are to protect their portfolios.
Here is how that insurance analogy works in practice. When big hedge funds or institutional investors see storm clouds forming on the horizon, they go out and buy insurance in the form of financial contracts called put options.
Right, to protect their downside.
Exactly. Now, just like real life, if every single homeowner in a coastal city suddenly tries to buy hurricane insurance the day before a Category 5 storm hits, the price of that insurance goes through the roof.
Oh, absolutely skyrockets.
So in the market, the more people scramble to buy these protective put options, the more expensive they get. And as those options get more expensive, the VIX spikes.
And understanding the temperature zones of that thermometer is just crucial to understanding the current market. The VIX has very clear historical baselines.
What do those zones look like?
Well, a reading below 20 indicates a calm market. Investors are confident, perhaps even a bit complacent. Moving into the 20 to 30 range, though, puts you in the stress zone.
Which is exactly where we're sitting right now.
Yes, hovering around 24 to 25 in early April 2026. This is where uncertainty really mounts. But anything above 30 indicates outright panic. That represents a major crisis, a severe geopolitical shock, or a liquidity event.
And we just kissed that panic zone. On March 27th, the VIX actually hit 31.
Which is an incredible spike.
It is. To give you context for how rare that is, hitting 31 places the VIX well into the highest historical decile of volatility, which starts at 28.3. But I know for an everyday investor, a number like 31 on an index can feel a bit disconnected from reality. Let's look at a secondary metric.
Sure. The CNN Fear and Greed Index paints the same picture using different brushstrokes. It aggregates 7 different market momentum and volatility signals, and it is currently flashing a 13 out of 100.
Oh, wow, a 13.
Yeah, that falls strictly into the extreme fear category. 6 of its 7 underlying indicators are at maximum pessimism.
So the market is effectively running entirely on fear right now.
No matter how you slice the historical data, this specific level of concentrated fear has only appeared on about 3.4% of trading days since 2011. The herd has stampeded for the exits. They are dumping equities, piling into U.S. Treasuries, and entirely shunning risk.
Okay, I have to push back here.
Go for it.
If I'm listening to this and I turn on the news, I'm seeing massive macroeconomic shocks happening all at once. If the world is actually facing unprecedented disruptions, why shouldn't an everyday investor just run for the exits too?
That's a fair question.
Right, like if the ship is actually taking on water, isn't fear completely justified?
The fear is anchored in real-world events, absolutely. To understand why investors are fleeing, we have to isolate the variables causing the VIX to spike right now. We are currently looking at four major overlapping catalysts creating this massive wave of uncertainty.
Okay, the first one is entirely geopolitical, and it centers on energy. On February 28th, following military operations involving the US, Israel, and Iran, the Strait of Hormuz was closed.
Which is massive.
Right, and just to visualize this for you, the Strait of Hormuz isn't just a shipping lane. It's a tiny geographical bottleneck between the Persian Gulf and the Gulf of Oman. At its narrowest point, it's only about 21 miles wide.
And approximately 20% of the world's global liquid petroleum passes through that narrow waterway every single day.
Wow.
Yeah. Closing it represents the single biggest energy supply disruption in history. The immediate mechanical result was Brent crude oil shooting up above $100 to $110 a barrel. The market despises uncertainty regarding energy supply.
Because energy dictates the cost baseline for the entire global economy. You feel that immediately at the gas station when prices jump 40 cents overnight.
Exactly.
But expensive oil doesn't just mean it costs you more to fill up your car. It means it costs a manufacturer more to run their factory, it costs a logistics company more to ship goods across the ocean, and it costs airlines more to fly.
And all of that massive increase in operating costs gets passed down to the consumer. Which brings us to the second catalyst, the Federal Reserve's massive dilemma.
Right.
Because this supply shock creates what economists call sticky inflation. And this is an absolute nightmare scenario for a central bank.
Why is that such a nightmare?
Well, the Federal Reserve's primary tool to fight inflation is raising interest rates, which slows down consumer demand by making borrowing more expensive.
But this current inflation isn't being driven by consumers buying too many things.
Exactly. It is being driven by a physical supply shock, an oil blockade. Raising interest rates doesn't magically open a shipping lane or create more oil.
So the Fed's only tool is fundamentally broken for the problem at hand.
It ties their hands entirely. The market was previously pricing in rate cuts, expecting a period where borrowing money would become cheaper. But due to this oil shock, there is growing concern that the Fed has to shift its stance back toward rate hiking just to keep this sticky inflation from spiraling.
And to compound the anxiety, Jerome Powell is just 6 weeks away from leaving his post as Fed chair.
Yes.
The market is dealing with a historic pivot in global monetary policy, right at the exact moment the captain of the ship is packing up his office. Markets love predictability, and a lame duck Fed chair during an inflation crisis is the opposite of predictable.
Oh, totally. And this uncertainty acts as a wrecking ball for the third catalyst, which is the broader market pullback.
Yeah.
You have to remember the context of early 2026.
Right. The market started the year incredibly hot.
Very hot. But equities do not go up in a straight line. Facing high oil prices and high interest rates, institutional investors are now actively selling off aggressive growth sectors to hide in safer defensive stocks that pay dividends.
But wait, if borrowing costs are going to stay high because of this oil shock, how does that impact those high-flying tech valuations we've been watching? We've been riding this artificial intelligence euphoria for what feels like years.
But high borrowing costs immediately compress the valuations of those tech companies. That is the fourth catalyst. The honeymoon phase of the AI boom is fading.
Oh, I see.
Yeah, tech companies heavily involved in artificial intelligence were priced for absolute perfection. Investors were willing to pay massive premiums for future growth.
So there was zero room for error.
Exactly. Now, if a major tech firm releases earnings that show even the slightest imperfection or a minor deceleration in their projected cloud revenue, the market punishes the stock severely.
Okay, so connecting the dots here, we have a historic oil blockade, which drives up the cost of manufacturing and shipping, creating sticky inflation. That inflation forces a lame duck Federal Reserve to keep interest rates painfully high. Those high interest rates make borrowing expensive, which pops the valuation balloon on all the massive tech companies that have been driving the stock market's growth.
Yes.
When you lay out the mechanics like that, a VIX hitting 31 isn't just random fear, it's a domino effect.
It is a logical chain reaction. But this leads to the most important question for a retail investor. How do you respond to it? Because what's fascinating here is how this macro-level logical chain reaction completely distorts reality at the micro level.
How so?
When the VIX soars this high, it creates a contagion effect. We see the emergence of a fear premium.
Okay, let's define that fear premium. In a rational market, you evaluate a company based on its individual merits.
Right.
You look at its balance sheet, you look at the cash it generates, and you look at its revenue growth. If a company is burning cash and losing customers, the stock drops. If it is highly profitable and growing, the stock goes up.
Exactly. But in a contagion event driven by extreme fear, the herd completely stops looking at those individual balance sheets. The selling becomes indiscriminate.
They just sell everything.
Everything. They sell the heavily indebted, failing companies, but they also sell the fundamentally flawless companies. Top-tier, foundational market giants get treated exactly like weak, speculative names.
It's like a fire alarm going off in a crowded, dark theater.
That's exactly what it is.
The crowd doesn't stop to evaluate if a business is a sturdy steel exit door or a fragile cardboard prop. They just trample over everything in a blind rush to get out of the building. And the data from our sources shows this exact stampede happening to the strongest companies on Earth. Let's look at Apple.
Okay, Apple's a great example. In their first quarter fiscal 2026 earnings, Apple generated $143.8 billion in revenue. That represents a 16% year-over-year growth.
Wow.
Yeah, and their diluted earnings per share, which is just a measure of their pure profit divided by the number of shares, was up 19%. But the most staggering metric is their trailing 12-month free cash flow.
Let me pause to translate free cash flow because it's arguably the most important metric in finance. Free cash flow is simply the money a company has left over after paying all its operating expenses, paying its employees, and maintaining its equipment.
It's pure, usable cash.
Right. It can be handed back to shareholders as dividends, used to buy back stock, or used to acquire other companies.
And Apple's trailing 12-month free cash flow reached $123.324 billion.
Just to visualize the sheer scale of that number, with $123 billion in cash, Apple could walk out and buy a massive Fortune 500 company outright, in cash, every single year, and still have billions left over to keep the lights on.
Yeah, it is a true financial fortress.
And despite that 16% quarterly revenue growth and a fortress balance sheet, the fear premium has dragged Apple's stock down significantly.
It currently trades at a trailing price-to-earnings, or PE, ratio of 31.22. The PE ratio simply tells you how much you are paying today for $1 of the company's current earnings.
Right. Paying $31 for $1 of earnings from a company growing revenue at 16% with that much cash is remarkably reasonable.
Extremely reasonable. The market is artificially depressing the stock price based on global fear, not on Apple's actual ability to sell iPhones and services.
And it is happening across the entire tech sector. Let's talk about Microsoft. If Apple is a fortress, Microsoft is an empire. Our research notes show that Microsoft is sitting on $89.46 billion in cash and short-term investments.
And their fundamental performance is just as robust. For their fiscal 2026 second quarter, Microsoft reported overall revenue of $81.3 billion, up 17%.
That's huge.
But the engine of their future growth, Microsoft Cloud revenue, was up 26% to $51.5 billion. When you look at their core operating profit, stripping away one-time accounting variables, their earnings rose 23.6%.
Cloud revenue is the holy grail of modern business. It is recurring, high-margin, sticky enterprise software. Companies do not cancel their cloud infrastructure just because oil prices go up.
No, they absolutely need it to survive.
Right, so Microsoft is growing this incredibly lucrative business by 26%, growing overall revenue by 17%, and hoarding nearly $90 billion in cash.
Yet the herd is selling them off indiscriminately. Microsoft's forward PE ratio, which is how much you're paying for $1 of their projected earnings next year, has dropped sharply to 22.26.
Oh, wow.
Yeah, that is a significant discount compared to its own 10-year historical average. The market is entirely ignoring a 26% growth rate in cloud computing and focusing purely on the geopolitical panic regarding the Strait of Hormuz.
But surely the defensive stocks are holding up. You mentioned earlier that when fear strikes, people hide in defensive, dividend-paying names. So a legacy healthcare giant shouldn't be dropping alongside a tech company.
You would expect that in a rational market, sure. But the contagion is so severe that even the ultimate defensive giant, Johnson & Johnson, has taken a hit.
Wait, really?
Yes. Look at their Q4 results. Johnson & Johnson saw sales increase by 9.1%. Their full-year revenue grew 6% to $94.2 billion. They are paying a very healthy 2.14% dividend yield.
Which normally provides a solid floor for the stock price because investors want that guaranteed income.
Exactly. They have a trailing PE of just 18.66. It is a rock-solid, boring, cash-flowing healthcare business. Yet it is being trampled in the same rush for the exits as the highly speculative tech names.
This is the critical insight for you listening to this deep dive. The broad market is taking a tech company with 16% revenue growth, a software giant with 26% cloud growth, and a legacy healthcare company that pays a guaranteed dividend.
And treating them exactly the same.
Yes, treating them exactly the same as companies that are actively failing. They're all just painted red on the screen.
That is the ultimate manifestation of the fear premium. The market is pricing in a global economic collapse rather than pricing the underlying health of the businesses themselves.
Which leads us to the most important part of this discussion. Here's where it gets really interesting. If fundamentally flawless companies generating hundreds of billions in pure cash, are being sold at a massive discount strictly due to macroeconomic panic, what happens next?
That's the million-dollar question.
Right. If I see Microsoft trading at a massive discount to its historical average just because a shipping lane is closed, is this the moment I should be deploying my cash?
History provides an incredibly clear, data-driven answer to that. While steep red arrows on your brokerage app are psychologically terrifying in the moment, periods of extreme volatility consistently act as a catalyst for massive long-term stock returns.
Tell me more about that.
We have a comprehensive data set from Creative Planning's chief market strategist to back this up, tracking the S&P 500 from January 1990 all the way through March 2026.
That is 36 years of data. That timeline covers the dot-com bust, the 2008 global financial crisis, the 2020 pandemic lockdowns, and multiple geopolitical wars.
It covers every major panic of the modern era. And the pattern is striking. We talked earlier about the VIX being divided into deciles, or blocks of 10%.
Right.
Over that 36-year period, the highest decile of extreme fear begins at a VIX reading of 28.3.
Which, just to remind you, we easily crossed on March 27th when the index hit 31.
When the VIX enters that absolute highest decile of fear, the S&P 500 generates an average one-year forward total return, which includes price appreciation and reinvested dividends of 22%.
A 22% return in a single year.
On average, yes. To understand the magnitude of that number, let's look at what happens the rest of the time. During the other 9 tamer deciles of VIX readings, when the market is relatively stable, the S&P 500 averages an 11% forward total return.
Let that sink in for a second. When the market is calm, when the news is positive, and everyone feels incredibly safe investing their money, you average an 11% return.
Right.
But when there is a historic global energy blockade, the central bank is in turmoil, the CNN Fear and Greed Index is flashing maximum panic, and the VIX is screaming above 30, your average forward return doubles to 22%.
It doubles. And that outperformance isn't just a one-year anomaly. The historical data proves that forward total returns were significantly higher following these periods of extreme volatility at every single timeline measured, from 1 year all the way out through 5 years.
Mechanically, how does fear create that much future profit?
Because extreme fear creates severe price dislocations. When the VIX spikes, it forces the irrational, indiscriminate selling we saw with Apple and Microsoft. It pushes the stock price of a phenomenal company far below its actual intrinsic value.
Right.
The underlying business hasn't degraded. Apple is still selling millions of phones. Microsoft is still powering global enterprise software. But their stock prices have been artificially compressed by a macro panic.
It's like holding an inflated beach ball underwater. The harder you push it down beneath the surface with all this panic and fear, the faster and more violently it shoots upward the moment you finally let go.
That is exactly the mechanism. Eventually, the macro shocks fade. The geopolitical tensions in the Strait of Hormuz will eventually stabilize. The Federal Reserve will eventually set a clear path for interest rates.
And when that broad panic recedes and the herd stops running, the stock prices aggressively snap back to match their massive free cash flows and revenue growth.
And this reveals the core mistake that most retail investors make. When the herd is stampeding for the exits, the natural human instinct is to sell everything and hide the money under a mattress until the news looks better.
But the data shows that waiting for the news to look good means you miss the 22% snapback.
Exactly. The smart move is to use this fear-driven price dislocation to deploy fresh capital or to rebalance your existing portfolio into these high-quality names while they are sitting at deeply discounted prices.
You seek out the companies with proven revenue growth, expanding free cash flow, and newly compressed valuations.
It fundamentally proves the wisdom behind Warren Buffett's famous axiom: Be fearful when others are greedy, and greedy when others are fearful. Right now, the VIX and the Fear and Greed Index are telling you mathematically that the market is terrified.
So, to bring this all together for you listening, the panic you are seeing on your screen is rooted in reality. The catalysts, the geopolitical supply shocks, the sticky inflation, the Fed uncertainty, they are valid macroeconomic challenges.
But Wall Street's emotional reaction to those challenges has created a blind contagion. They are pricing phenomenal, cash-rich companies as if they are fundamentally broken.
Which leaves you with a very important question to ask yourself as you look at your portfolio today. Look at your own watch list right now. When you see a stock flashing red, ask yourself, are you looking at a company that is actually failing to generate revenue, or are you just looking at the fear premium of a high VIX?
That's the real test.
If volatility is the historical price of admission to Wall Street's greatest wealth creation, what opportunities are currently hiding in plain sight in your own portfolio while everyone else is busy looking for the exit? Thank you for listening to this market briefing from Balance of Economy. Our goal is to provide the signal within the noise through deep research and AI synthesis. If you found value in this analysis, subscribe and hit the notification bell. Stay sharp and stay informed.